This is Tim Phillips, Chief Investment Officer at Phillips & Company Advisors. I'd like to welcome you to our 2021 Q1 look ahead. We hope this recording finds you safe and healthy while we work through this very challenging period in public health. Please read all the disclaimers and disclosures carefully. This time of year, we always take a quick look back and then look forward. Last year, Wall Street prognosticators predicted markets would be up over 1.5%, with GDP growth coming in at 1.8%. If there ever was a time to throw cold water on predictions, now's that time. In light of the global pandemic and medically induced economic shutdown, the U.S. economy actually shrank by 2.8%, missing forecasts by 255%. And the S&P 500 was up an astonishing 16%. Again, Wall Street forecasters whiffed that by 970%. This year, this group of Wall Street masterminds is calling for the S&P to be up 7.43%. And you can see GDP growth forecasts for 2021 below. Note, China's almost lapping the United States in GDP growth, according to the IMF. Before I throw any real cold water on the S&P forecast of being up 7.4%, I should point out that there's some real investment and consumption rocket fuel sitting in the economy. Precautionary savings that was built up during the pandemic, mostly through U.S. fiscal policy, is being spent down, and you can see that on the left. If that returns to normal, that would be 5.4% added back to GDP growth. You can see on the right, credit card balance has been paid down, and if they return to normal, that's another 0.5 percentage point to GDP. And of course, non-revolving credit is on a tear with major purchases like motorhomes, new homes, and all the things you need to put into those homes. Let's keep going. Mortgage applications are still on the rise, and debt service as a percent of disposable income is at historic lows. If consumers return to peak levels, that's another $2 trillion or nearly 10% more of GDP growth. So the question is, will they spend? In my estimation, if a vaccine rolls out at the median expectation, animal spirits to consumers will return and jobs will return in some key areas like restaurants, hotels, and airlines. Perhaps it's the perfect intersection of vaccine consumption and stimulus release that could drive a whopper of year with almost 10% of GDP in consumption dry powder. The big question is if they will spend. Next year really represents a base effect year in our estimation. Lots of earnings and maybe no price appreciation. The base hurdle for the S&P earnings are so low it's hard for corporate America to not beat those muted results. And you can see year-over-year comparisons for each quarter and the full year for 22% earnings per share growth compared to the contraction of 13% in 2020. This certainly could be another great input for the S&P 500 in 2021. Now, I don't want to be a wet blanket, but historically, when we're facing forward price to earnings valuations as we're at these levels in the high 20s, we typically see pretty muted returns. And you can see that from the chart in the middle. In fact, when you see periods similar to what we've been through from a valuation perspective in 2020, markets tend to only average about 4% versus the 7% Wall Street prognosticators are calling for. Now let's level set expectations, and perhaps we see no increase in S&P 500 price appreciation and simply a reduction in values. In my mind, we all need to be prepared for this range of outcomes as 2021 holds a lot of pitfalls for investors. Certainly, central banks will be a major input into the outcomes for 2021. Their coordination will be critical. Most central banks are calling for much lower rates for longer, with the likelihood of the labor force participation rate being a major indicator. On the U.S. side, it's clear the Federal Reserve will tolerate more wage inflation to lift those in lower wage jobs and minorities in the service sector to reap some of the benefits of the next economic expansion. Lower rates for longer are not just an economic discussion, but they now appear to be a social justice discussion as well. This could help those least fortunate in our communities. While we know U.S. equities are hard to predict, it seems fairly easy to suggest fixed income investing becomes much more challenging in 2021. Rates, as we mentioned, will likely be stable and very low, and with most investors holding between 30% and 50% of fixed income in our portfolios, we'll need to adjust to the very narrow spreads between high yield and AAA credits, and you can see that in the upper left. The full range of fixed income options are on the right, and they don't suggest much in the way of returns either. I certainly expect some yield chasing in very specific sectors like energy and real estate that could cause some issues if there are credit downgrades and defaults. In our estimation, active management in fixed income is really the key in 2021. So where do investors go for returns to meet needed payouts in 2021? It looks like emerging markets. Based purely on valuations, EM, and specifically China, offer the best growth to valuation possibilities. Both charts on the left reflect that. In fact, in a recent survey by Bank of America, they suggest most fund managers favor EM as an asset class in the coming year over almost any other asset class. Let's focus on China for just a moment. While not a China apologist, I do think it's important for us to understand how China thinks as we enter 2021. Founding member of the CCP, Chairman Mao said as early as 1923, I quote, "Isn't it true that the Chinese government," and he was referring to the Nationalist Party of Chiang Kai-shek, "isn't it true the nationalist government is a counting house for our foreign masters?" I think China is at a critical moment in the history of ours and theirs. President Xi, who is deeply informed by Chairman Mao's teachings, is very cautious about becoming an economic pawn to the United States or other countries. And I believe we should expect to see China's independence flexed in 2021. Of course, you can see on the left, they've had tremendous return to normal post-COVID. Again, in the middle, you can see China did two massive trade deals at the end of 2020. The RCEP is the largest trade deal in the world with 30% of GDP and 27% of global merchandise. China just signed the EU CAI that engages China and the EU in bilateral trade with their 27 countries. This will certainly help China reach a crossover point where they will become the largest economy in the world by 2028. In our view, developed markets still do not provide enough growth to consider a tilt back to policy weightings. Although Brexit's finalized and a fiscal stimulus program from the European Central Bank has been approved, the implementation of both of those pose considerable threats to Europe. Even though China and Europe signed a great trade deal, we believe the greatness in that deal will really be in the implementation. And that implementation will determine whether we return developed markets back to policy weighting or continue their underweighting. With a democratically controlled presidency and legislature, we should expect to see at least one, if not two, tax reconciliation bills that will make some large changes. We summarize what we believe an unconstrained Biden presidency with policies look like on this slide. While there's much consternation in America over the election disputes, it's critical to understand that 2022 Senate elections have just started. With 34 Senate seats, 20 of which are Republican, up for grabs in 2022, those Republicans are already mining for Trump voters. In the end, there are really only 7 competitive seats: Arizona, Georgia, Nevada, New Hampshire. North Carolina, Pennsylvania, and Wisconsin. With redistricting, a narrow House lead for Democrats, and historical trends of flipping the House in off presidential years, a divided government may not be too far in the making. There's a unique opportunity with dollar-denominated commodities. With a coordinated global opening of economies throughout the world and a risk-on approach to currency trading versus just simply buying safe haven US dollars, we should see a resurgence in industrial commodities. This could be the greatest mispricing in assets since the great financial crisis, and we would emphasize a hard look at industrial commodities within portfolios. I recently concluded an interview with well-known author Morgan Housel on his recent book, The Psychology of Money. The link is below, and the interview is on our website. One of his encouragements is to try and look at risks people talk about versus real risks. You can see our attempt at that exercise here. The most interesting to me being the global dependency on Taiwan Semiconductor and their advanced 5-nanometer chip. The other being the vaccine having very limited duration. Let's all collectively accept we cannot know what risks we face in 2021, and that's the major takeaway from the lessons we learned in 2020 and the pandemic. With a complete collapse in earnings across the globe in 2020, our mean reversion dashboard flashes a lot of red. However, you have to look forward to 2021 earnings to find some bright spots. Please take a look at the dashboard at your leisure. Our economic dashboard, similar to our mean reversion dashboard, flashes mixed signals. Please review that as well. Our views and recommendations are summarized here. Again, you can see the dependency on coordinated central banks, our focus on China as an emerging global superpower. And again, I would encourage all of you to click on the link below to listen to our interview with famed author Morgan Housel. Of course, you can access that on our website. On behalf of all my partners and team members at Phillips & Company, we thank you for your time as we discussed our Q1 2021 look ahead. We also wish each of you and your families a very prosperous, happy, and most importantly, a very healthy 2021.